Hey all, welcome to ShareTreck. Today is the 11th of February 2022, and boy, the market is really strange, and I hope you're having a lot of fun looking at what's happening in the indices and the stock prices. That's the only way to take it. You need a sense of humor in order to survive in this market. So having said that, let us get started looking at what exactly happened in the market and what's going to happen next. So here's my take. Today I'm not going to do too much of technical analysis because it's going to be a moot point, but I would like to share my thoughts with you on what's happening with the economy, what's happening with the market, and why we are seeing those kind of strange volatile moves and what to expect next. And let's first start with earnings. So if we look at our earnings calendar, Pfizer was lukewarm. Disney and Uber were fantastic in their outlook as well as their results. AstraZeneca was also pretty good, and they sure did report. Expedia did well despite Omicron, and that's a big positive news for the market. Adjusted EPS for Expedia at $1.06 versus estimate of 0.60 cents is basically almost 45% above expectations of the street, and as a result the market is exuberant, and it also sends a message to the market that Omicron might have been really overestimated, and maybe it's not as bad overall as it was originally thought based on our experience with Delta and the original COVID. And one of the big points here is business to business revenue was an area where there was a big beat. So that kind of indicates that probably corporate travel has resumed. That's one thought I might have in my mind. When we come to Zillow actually did worse than expected in most counts, but in the home segment, revenue came in at 3.35 billion, where the estimate of the street was 2.31 billion, and that's why the Zillow shares popped after earnings, and that brings us to a close of the earnings roundup. So overall, what I'm seeing, if I don't look at the VIX, if I don't look at the share market price and everything, and I just look at the earnings so far from the last 2 weeks, the message I am getting, or my interpretation of it, is that Omicron is not as severe as we thought. COVID-19 and Delta was a different beast. Though highly infectious, Omicron doesn't seem to be causing much of a problem because those vaccinated are likely to stay out of hospital and have milder symptoms. Omicron itself is the news reports indicate itself doesn't create that huge of a fatality, and more vaccine coverage indicates that less people are likely to have the fear of catching Omicron, and even if they caught Omicron, their fears of going to the hospital is much reduced. Therefore, there's a great deal of movement in the market. You saw that with the Uber results, and we saw it now with Expedia also, and with Disney. So that gives me a good comfort level in terms of what to look forward to going forward. So what happened was, yesterday when I was recording the video in the morning, at that time, I think I finished recording the video around 10:30 a.m. if I'm not mistaken. So at that time, the bond market had not yet reacted. So I believe one of the Fed chiefs had remarked that we might have to do a 50 basis point hike, and we have to do it quickly. And that kind of spooked the market. And later on, the media reached out to the Federal Reserve, and they were reassured that no such thing is happening. There is no 50 basis point hike in the offing. And if we look at yesterday's scenario, somewhere after the market opened and somewhere close to around 11 o'clock, people started visualizing that 50 basis point hike and an emergency FOMC meeting. And that's what kind of spooked the market, and the VIX just went up. And as a result, all the share prices started coming down. So now that fear has been assuaged, that's why the VIX is coming down, and the share prices are popping up a bit. But let me tell you, today's boost in the CRISPR stock prices is not a permanent thing. So if you have profits that can be taken, I think, in my personal opinion, again, this is my personal opinion and not financial advice, If I had CRISPR stocks which are positive at this point of time, I would take the cash and wait in the sidelines, because even though outlook seems to be much clearer, people make decisions based on various things that they hear. The fear factor is already here. The main culprit, in my opinion, is inflation apart from supply chain. So these are the ones that have caused all the problems and risks that we visualize in the market. The main culprit in inflation is the energy prices. They flow through food and other consumables due to transportation. With the trucker strike already here in Canada, Honda has declared that they're going to cut production in Canadian plants because we have a free flow of materials between Canada and the US, and with the border, 3 border points being blocked up by the truckers, Honda has already cut production. So now Canada is going to start importing inflation due to this bottleneck. We didn't have that problem before. And this is also going to affect and aggravate the inflation situation in the US much more. A lot of lumber goes from Canada to the US, and that goes into construction. And already the construction, the new home prices are all going up, and this is going to feed into more inflation out there. Energy prices can quickly fall. They can quickly fall if the supply is increased. If geopolitical tensions go down, they can fall very steeply and very quickly, and they can be reflected in the next CPI release when it happens. Likewise, company earnings and forecasts tend to show Omicron will not be an issue, so we should expect supply chain woes to work out progressively. So having said that, in many cases the reaction from media does not have a purely objective basis. It does have a good portion of political bias depending on which media you're looking. And rather than any consistent view on monetary policy, that's what happens. There's always a political spin to it. If one was not concerned about massive government spending, ballooning debt, and loose monetary policy 3 years ago when the $1 trillion tax cuts were given and the money was given to people for COVID relief, then the current criticisms of the deficit being too high and all that things do not hold muster. That's in my opinion. And so whatever the media is saying, regardless of that, the inflation might be transitory. How long it takes for the transition to happen depends on all the factors that we have in terms of the supply chain bottleneck and tight labor conditions. We have had 2 years of pandemic that has periodically shut down and slowed output of almost every raw material manufactured and finished goods. And just as the demand was recovering from the shock, we have the supply chain bottlenecks and the trucker strike and the energy prices going high. So earlier we had the issue of relatively low vaccination rates that allowed a lot of variants to take hold. Right now in the developed countries, we don't have that problem, but we still have some in the underdeveloped countries and the third world countries where the vaccination rate is still low. And when I look at the pharma companies which have declared their results, they are still predicting same COVID revenues on vaccines and therapies. So I'm going to think that those are going to come from the third world and the underdeveloped nations and developing economies where the coverage is not high. And with that said, we are going to be in an increasingly more conducive and better environment going forward with regard to Omicron. So things should get better and not worse. However, we will have the people in the media talking about and interpreting all these things according to their political bias also, and also knee-jerk reaction from investors who also inherently have political biases built in. All those things are going to keep the market volatile. So it's up to you. If you feel that, if one feels that this is the time to take profits wherever available and hold money and wait in the sidelines, that's also a valid strategy. And to continue being in the market, not moving anything and hoping for better times to come ahead, that's also a good strategy. I mean, it's up to our own risk-taking ability and what we feel about the economy. Now, I'd like to go off to discuss about a concept I have in mind, which I want to bounce off all of you. I'll just give you a brief anecdote. Years ago, many decades ago, like I was in Ireland for 4 years. That was during the Celtic Tiger period. The economy was booming and everything was fantastic out there. And I had just gone in from India and settled down there. We had a situation where the government was having low interest rates in order to spur the business and the economy. The euro was just introduced, the Irish punt was retired, and Ireland went into this global kind of a situation. Instead of the Irish central bank managing its own interest rates, it was the EU which was managing the interest rates. So even though economy was booming in Ireland, the interest rate was still low from an EU perspective. And Ireland was growing the fastest among the European Union countries because of low corporate taxation, a lot of investment from the US, the dot-com bubble. Everything was happening. So I was getting unsolicited letters from the bank saying that, would you like to borrow 15,000 euros or 20,000 euros, low interest rate. So I decided to just borrow, because back in India, I was getting around 10 to 11% per annum, and I was going to pay very low, around 2% or something in Ireland. So I just borrowed, I sent the money off to India, regardless of the exchange rate risk, and it became the foundation of a big portion of my Indian equity portfolio, which is doing excellent right now. So the arbitrage took place. At that time, the advantageous situation was that the Indian rupee was very controlled, and there was no free movement of the Indian rupee into the international market. So that was a good thing. And the second conducive thing was that the European Union overall had a low interest rate because of the economic condition. But Ireland was an island of really high growth and high employment generation, high productivity and everything. So ideally, Ireland should have had a much higher interest rate, but it did not. It was an artificial situation. So now coming back to where I'm going to with this is that on one hand, we have the US economy, which is in a state of overheating with very low unemployment numbers, tight labor market, high inflation, supply chain shortage feeding into the inflation, tight labor market feeding into the inflation. Remnants of Omicron restrictions are still in play. There is a crumbling infrastructure. We recently had a bridge collapse. Money needs to be put into infrastructure. However, US dollar is a reserve currency for many countries, and it is freely floating, which means many countries park their extra funds, foreign exchange, in US dollars. So that's the situation. And now if you look at China, which is a huge player, and I challenge any of you watching this video, take an inventory of everything in your house and start looking at the country of origin. You will find that almost 70 to 80% of everything you have in your home has been made in China. So that's the kind of economy we are talking about. So the Chinese economy is facing a slowing down. It has got increased downside due to downside risks due to Omicron, because when initially COVID struck, they were draconian in their approach and they put a big control into it. And now with the Olympics and all in progress and the Omicron surge coming in, they are having a lot of strain on the economy. Ongoing efforts to address the excessive leverage in the corporate sector. We remember the Evermead case, the real estate side. So that's also going on to put a control in the economy and bring that excessive leverage into much more reasonable levels. And for China, the traditional playbook of boosting growth through infrastructure and real estate investment is kind of at the end of line, because they already put a lot of money into the infrastructure, not only within China, but also in Africa, Sri Lanka and other places where they have put money, and those countries are not able to pay back the money that was put in those infrastructure. So those playbook has already run its course. So for China now, what they need to do is to rebalance external and domestic demand and move from investment and industry-led growth to greater reliance on consumption and services domestically. And in order to do that, there should be greater income equality, and the government is working on making those structural changes. Shifting from significant weight placed on state leadership and regulation to a greater role of markets and private sector in boosting up the demand and stabilizing the economy is another thing that they would be aiming towards. And transitioning from a high carbon to a low carbon economy is also a top priority which the Chinese government is working towards. And as a result of that, China is definitely not in an increasing interest rate regime. And they are also a global supplier. So if they start doing carbon pricing and they start switching to a much more renewable resource kind of energy structure, then it's going to put a lot of pressure on the global supply chain, of which China is a big part. And any problems there can then transfer to other parts of the economy. But one redeeming factor for China is that they have a great deal of control on their currency. In China, companies, banks, and individuals must comply with a closed capital account policy, which means that money cannot be freely moved into or out of the country unless it goes through a strict foreign exchange rules vetting. So there's a lot of control out there. Therefore, what I did in Ireland cannot be done by people in China. They cannot take the low interest from there and put it directly into US or some high interest rate regime. So that's one of the saving graces for China in terms of being able to control its own economy. Otherwise, if that control was not there, what would have happened is a lot of Chinese funds would flow from the low interest Chinese environment into the US, further aggravating the whole situation. So this is kind of a thing which in my mind is playing out in the background, which probably the market is not fully pricing in. The US debt is also at an all-time high. So if the US was to raise the interest rate going forward, which it typically does in 25 basis points, then the US is going to have a much bigger burden servicing that debt, which is running into trillions of dollars. So I do not see interest rate hikes coming up very quickly. First, the tapering has to complete. That is supposed to happen end of February and March at the earliest. And after that, the Fed said they will start raising interest rate. And now we have clarification that it's not going to be a 50 basis point. It will still continue to be a 25 basis point hike. So we have a situation now which is much more clearer than what it was yesterday. And that's why the shares have started moving up. But believe me, there is a lot of volatility in the market, and I myself personally would not make any moves and investing anything, and I'm looking at taking profits where I can and keeping the cash available in the sidelines until more clarity comes in. So that's what I would like to say for the day today. And just in order to have some amount of completeness, I would like to take you into looking at what's happening with the market. We'll do it very quickly because whatever I say right now, things may change very quickly. So let's do that next. So as you can see, we have the VXN here. Each candle is a day, and today's candle is high. It is right now at 30.22, having gone all the way up. And if you look at the candle out here, let me expand this. It went all the way right up to the resistance which we have here at 31.07. And while I was recording the earlier segment, it had come down, and now it has gone up again because it has got support from the 9-day EMA, which is at 29.87, this yellow line out here, and also the red line, which is the 20-day EMA. So it's got very strong support and to fall below. So that's where we are. And if we quickly take a look at the NASDAQ, we have the NASDAQ down minus 0.15%. And let us quickly go and have a look at the biotech. And as we can see here, many shares are still in the green, but wherever this is in the green, if I have anything, like I'm going to check and see if my ARCG is profitable at this point of time. Even if I have a small profit out there, I'm just going to take that and keep the cash handy because there is going to be more volatility in the market. Right now, we are struggling against this resistance, which happens to be at 14,227. And this resistance has been strong for quite a while. We have only periodically gone up, but promptly come down. I'm going to mark this as a resistance right now. And the overall conditions are looking really tough. The MACD is bullish and the momentum is also picking up. So these greens are not going to last too long. We'll have to wait and see what happens. So that's what I have for the day. Thanks, and have a great day, my friends. And please don't forget to put a like in the bottom. And if you are here for the first time, please consider subscribing. It will mean a lot to me. Bye for now.